Good afternoon, class. My name is Kran Amadu. I'll be taking you strategic financial management, and today we'll be taking the topic corporate or business valuation. We're doing the part one of this topic. Part one. Part one. This is ICAN SFN. We'll be taking the topic corporate or business valuation, sometimes called business valuation. Corporate or business valuation. So I'll be introducing the topic to you generally, then we'll go into why an entity may want to value its business, why an entity may want to value the business, why valuation or reasons for valuation. We'll also look at documents, reasons for valuation. We'll also look at documents that may be required for valuation of business. Documents that may be required for valuation of business. And we go into the various methods or basis of valuing a business. The various methods or methods or basis of valuation. Thereafter, we will conclude the class with practicing of some of the ICAN past questions on valuation. Past questions on valuation. So let's begin with the introduction of the term corporate or business valuation. What is a corporate or business valuation? This is a way of putting a price tag to an entity. It is a way of putting a price tag to an entity. By corporate valuation, we refer to the process of determining the net worth of an entity. That's the process of determining the net worth of an entity. It is a process of determining the net worth of an entity. The net worth of an entity. In trying to know the net worth of an entity, we will usually determine its market value. Like I said, it's a way of putting a price tag to a business entity. And market value, we determine its market value. And in doing that, there's this implicit assumption that the focus in determining the market value of an entity is on the equity value. That is the value of equity of the entity. Value of equity value. So that is the main assumption. The implicit assumption is that you are trying to know the equity value of that entity. Basically, there are two kinds of business entity which we refer to as quoted and unquoted business entity. We have basically two kinds of business or companies, two kinds of business or companies. We have the quoted companies, we have the unquoted companies. Unquoted companies. Well, in trying to know the business value or the corporate value of a quoted company, we simply go to the stock market and get the price of such company. First of all, what are quoted company? Quoted company are company that are listed in the stock exchange that are already trading in shares. They have a value attached to them already. So getting the value of a quoted company is as simple as the market capitalization. That is to know the market price per share of that company and multiply it by the number of shares in that company. And the number of shares is gotten by saying the book value of such shares, the book value of such share all over the nominal value of the share. That gives us the number of shares. This is the market value of quoted company. This is the market value of quoted company. Whereas for unquoted company, there are different bases of valuing unquoted company. We'll get there. I just needed to chip this in. So, like I said, business valuation simply refers to the determining the market value of a company. Why would an entity wants to know its market value? There are various reasons why a business entity may wants to know its market value. One of which is reasons for valuation. Reasons for valuation. One of it is because for the reason of sales, if it wants to sell the business, it needs a price tag to attach to it. For reasons of IPO, for quoted company that wants to go quoted, they want to make sales of shares. They need to know their worth so as to know what price to put on their shares. That is for business that want to do initial public offer of shares for sale or for subscription. Other reasons could be for merger and acquisition. When entity wants to merge with another, they will need to know their value so as to know the modality of carrying out such merger. Financial reporting reasons, such as financial reporting reason, such as the case of IFRS standards require businesses to know their fair value. There's also IFRS 13, IFRS 3, business combination also require that you know the value of a business. Then there are reasons such as tax reasons. For the reasons of loan, perhaps the entity wants to take a loan from the bank. Let me just call that raising of capital. Raising of capital. Take for instance, the entity wants to, whether it's equity or loan, whether it's equity or loan or debt capital. For instance, the entity wants to take a loan from banks. Some bank may require that such an entity value itself so that they know the value of the entity, whether it's worth giving such loan or not, in terms of collateral and other things. Other reasons why a business may want to know its net worth include admission or retirement of partner or shareholder or shareholders. For instance, when partner in a business wants to retire or a shareholder is leaving the entity, they may want to know the value of the business so that they know the portion applicable to such a shareholder or a partner, so as to know the modality of his exit or entry. Other reasons could be inheritance reason. There could be a situation whereby the members or owners of the business, maybe a part owner of the business dies and he leaves the business as inheritance to his children or whoever is the person he chooses to. Such person may demand that he knows the value of such a business so as to know what to do with his inheritance. Inheritance. There are other various reasons. So, but for example, this is quite enough a point for the reasons for valuation of business. You can still think of others. Documents that may be required for valuation of business. Documents that may be required when valuing a business as a professional. What document will you require the entity to supply you so as to value its business? Documents, relevant documents for valuation, documents for business valuation. Some of the key documents so the documents include, we may require financial or accounting data, such as statement of financial position, income statement, you may also require the business forecast or financial forecast, list of customers by revenue. You may require the receivable age list, receivable/payable age list. Other financial documents include also require any other financial documents that may be available. Any other financial documents. Another set of documents that may be required are legal documents, such as the business registration document, the registration document, certificate of incorporation from CAC, the memo of association, articles of association. You will also require the entity to provide you any litigation, threat of litigation, Please, let's continue on this side of the board. Threat of litigation, documents for business valuation. Threat of litigation, document that has to do with agreement with third party, like for instance, loan agreement, lease, contingent asset, contingent liability, any contingent asset, stroke liability, employee benefit, tax, issues, pending contracts, etc. Or any other documents, others. Let's do this number 3 as others. And other documents such as value indicators, whether you are creating value or not, what are the value indicators. These are some of the key documents that may be required while carrying out valuation of business, so as to be able to arrive at the net worth of the entity. Now we'll move on to the methods or basis of valuing business. The method or basis of corporate valuation. The methods of basis of corporate valuation. There are many bases or methods of valuing a business. However, and it is also necessary to say that valuation is not a science, it is an art. So there is no one figure that you can say it is the best of it all. It depends on negotiation at the end of the day. However, in line with our syllabus, I'll be treating 5 methods of valuation. Basis of corporate valuation. Basis of corporate valuation. In line with our syllabus, I will be treating basically 4 bases of corporate valuation. I will be dealing with the net asset basis of valuation. I will also be treating the income basis of valuation. I will also be treating the cash flow basis of valuation, and finally I will be treating the value base. For this basis, the value base, it's hardly seen or treated at the professional level of ICAN exams. It is mostly seen at the skills level. However, it is also part of the syllabus, so we'll be touching on it. The net asset basis of valuation, as the name implies, its focus is on the asset of the business. It focuses on the asset of the business. It focuses on the asset of the business. And there are various methods under this method. There are various methods under the net asset method. Most of these methods simply tends to look at asset in different ways. One reason or one critique of this method is that it is backward looking. It does not accommodate the time value of money. It does not accommodate time value of money. It is backward looking. That is, it is historical in nature. That is one of the key critique of this method. However, and some of the benefit is that it is very good for entities that are tangible assets heavy. Those entities that their business involve a lot of tangible assets. Also, it is good for valuing an entity that is going into liquidation or cessation, permanent cessation of business. It is good in valuing it because through that you'll be able to get realizable value of the asset. So, the various methods under this net asset basis are: 1. We have the net asset historic. Like I said earlier, it is historical in nature. This net asset historic simply look at the asset at their carrying amount in the statement of financial position. Of course, as an accountant, I know you know that assets are contained in the statement of financial position. So anything that has to do with this method, the focus usually is on the statement of financial position. Statement of financial position. The focus is usually on your balance sheet. It's usually on the balance sheet. The focus is usually on the balance sheet. So this looks at asset as their carrying amount in the balance sheet. What are they? Moment it's able to arrive at the total of the asset at their carrying amount in the balance sheet, removing the liability from it, it will give the market value of the business. It gives the market value of the entity. So it's simply net assets as it is contained in the balance sheet in their carrying amount less the total liability. So is total asset less total liability. This method basically focuses on the tangible asset. Tangible asset. A good question will be, so what happens to the intangible asset? What happens to the intangible asset? That is why there's a little variant of it where some people tend to want to accommodate the intangible asset. For that reason, they have a variant of it that says you calculate first the total assets, that's the total tangible assets, then add the calculated intangible value, then you less your total liabilities. Calculated intangible value is usually arrived at using the formula calculated intangible value is equal to the excess profit after tax, all over weighted average cost of capital. Excess profit after tax over weighted average cost of capital. How do you arrive at this excess profit? This method tends to look not only at the business it's valuing, but it looks at similar business in the industry and their profit level. When if you realize that the profit level is higher than the profit of the company it's valuing, then it looks at that profit as excess profit, and it tends to attribute that excess profit to the intangibles of that company. So I simply discount it using the weighted average cost of capital, add it to the tangible, then remove the total liability to get that value. Then in number 2 under this method is net asset realizable. Net asset realizable. Net asset realizable method. Net asset realizable method. Under the net asset realizable method, this method mostly is applicable to businesses that are closing down, entity that when there's a case of breakup, the assets are sold at distressed prices. So how much is being realized for such asset in comparison to the net asset historic? Why the net asset historic? Look at the value of the assets that is contained in the balance sheet. This looks at the actual amount that the asset is being sold as the business is closing down at that point in time. How much can we get for the asset? If we say, okay, PPE, right now we are selling machinery, a generator set. How much is the person that is pricing it, how much is ready to pay for it now? That is the net asset realizable method. That is what it looks at. When you calculate the value of asset in this regard, you take away the total liability to get the market value of the business. So it's usually still the same thing. Total assets at realizable cost less total liabilities. Total liabilities. Total liabilities. Alright, the third method under this method, net, is called the net asset revaluation. Method. In this method also look at the total asset. However, at revalued amount less total liabilities. So this method looks at the asset at their revalued amount. Sometimes entity tends to revalue their asset. You call an independent valuer to revalue the asset so as to not do away with the historic value and go with the revalued amount. One key thing to note while applying this method is that when the assets are revalued, sometimes you notice that some of the assets, their value tend to change. A key place of issue to students is that they look at those assets that their value did not change. They tend to think that those assets were not revalued. No. The good way to look at it is that every asset was revalued. For those that the value changed, you simply replace the value. For those that you notice that the value did not change, it means that the new value coincidentally is equal to the old value. It doesn't mean that it was not revalued. So you simply list out the assets that the value changed and also those ones that the value did not change to get your total asset less the liability. Then the fourth method here is net asset replacement method. Net asset replacement method also deal with total assets at replacement cost minus total liabilities. Now this looks at total assets from the point of view of if they want to be replaced. One key difference between this and the realizable method is that realizable method look at the total asset from the perspective of what we can get for it now at the distress price that we are selling it. Right now that they are selling the asset, how can we get? But whereas this looks at it from the perspective of in this asset is being sold in the market for how much? How much is it being sold in the market? How much is it being sold in the market? One way to look at this, like if you buy a phone today, you open that phone and take it out of the Igbo boy store, and you return back and say, take for instance, you bought that phone for 10,000, and you say you want to sell that phone, the same person you bought it from, it will be pricing that phone maybe 7,000 naira with the pack and everything right in your face. He knows that it's a new one, he knows that you just bought it from him. Whereas that same phone is selling for 10,000 naira right in his shop there. So what I'm trying to explain there is that whereas the replacement cost of that asset is 10,000, the realizable amount is 7,000 naira, because that is what is willing to pay for it right now. But the replacement cost, if for instance you were to go and replace that asset, take for instance you bought that phone, as you were going home the phone got missing and you want to go back to the market and buy another one, you will not go to the market and buy it 7,000, you will still pay 10,000. That is the replacement amount. That is one difference between this and the realizable amount. So it's also deal with the total asset at the realizable cost less liability. That is the asset method. Now let's go on to the income method. So we are done with the asset method. Let's look at income method. So let's say our income method, let's take that to this side. Maybe we'll only be able to do 2 today. Next class we'll deal with the other 2. Income method. The income method looks at the market value of an entity from the perspective of the income statement. The focus is on the income statement. It focuses the income statement in trying to arrive at the market value of the entity, and it uses many ratios. We are very conversant with some of these ratios from business analysis. It focuses on the income statement. The first method here is the PE ratio, which is the price earning ratio. Price earning, as we know it from our business analysis, the formula is market price per share all over earnings per share. Looking at this formula, since we are looking for market value, of course, it's the same thing as we are looking for market price. So if we say market price per share is equal to PE ratio times earnings per share, we have gotten the market price per share. If we multiply our market price times number of shares, we will get market value. This is the PE ratio method. Looking, then the next method here under here is the earning yield. Earning yield. Earning yield. Earnings yield. This method, as I said, looks from perspective of business analysis ratio. Any yield, as we know it in business, is earnings per share all over market price per share. Changing the subject of this formula, we will have market price per share is equals to earnings per share divided by earnings yield. This becomes our value. If we multiply market price per share by number of shares, we get our market value, which is the same thing as this, which is market price per share times number of shares. The number 3 here is dividend yield. Dividend yield. This implies that dividend per share all over market price per share, which means our market price per share is equals to dividend per share over dividend yield. And that applies to these two. Market price per share times number of shares gives you market value. Then the fourth one here, we have the PE ratio, we have the dividend valuation model. Dividend valuation model. The dividend valuation model is usually divided into two types because we have cases where dividends are constant. In vein, dividend valuation model, when dividends are constant, it says market value is equals to that constant dividend in year 0 all over cost of equity. You use the cost of equity to discount the dividend. However, when the dividend is growing, you will say market value is equal to the dividend that is constant into 1 plus growth all over cost of equity minus that growth rate. This is under this method. Also the fifth method, which is the Miller and Modigliani. Miller and Modigliani proposed this method, and they said that market value of a firm is equals to its earning before interest and tax discounted using the weighted average cost of capital. I know you know what we mean by KE, cost of capital, through our cost of capital lecture, and also know what is weighted average cost of capital. The average cost, that is the cost of the debt, cost of equity, add together, taking the average, that is the weighted average cost of capital. So these are the two methods or bases that we'll be able to deal with today. Next class, we will be dealing with the other two before we go into applying each of these methods in solving questions. So you can take down your notes